is Mommy Belluga Investing.
Hi there, back again with me Rati in Mommy Belluga Investing. In this video, I'm going to analyze Ban Leong Technologies Limited with the stock symbol B26. I found this company again in the Belluga portfolio, my husband's portfolio, and I'm curious about this company. After looking at the numbers, quick take for Ban Leong, my quick take are it's a potentially growing company provided that it can leverage on the current sector's growth. It has a high dividend yield, which I like, while currently having quite okay dividend payout ratio. I'm interested in putting a small position in the company in the near future. Okay, how did I reach the above conclusion? Follow my video as I quickly discuss the company's profile, EPS, dividend, and other numbers. Please consider to subscribe because it means a lot for a beginning YouTuber like me. If you have any comments or input, do not hesitate to put in comment section. It'll probably help me to get more perspectives and learn more. Okay, before getting into the data, I read out the disclaimer first. Okay, disclaimer, this is an amateur video. My main intention is to record my journey learning and practicing investing from scratch. Over time, you may find that some inconsistencies in my analysis and conclusions. Please bear with me. My analysis is limited to the public data that I can access and the scope of my knowledge. Both of those change over time. This video shouldn't replace any financial advice and neither suggestion to take a position, buy or sell in the stock market. Please conduct your own research before making any decision. But if you do your own research, I hope this video will be useful for you somehow. Now let's start from a brief company's profile. Okay, Ban Leong has their financial year ended in March 31st since 2009. Before that, their financial year ended in December 31st. Ban Leong is a brand name in the technology products distribution industry for the past 27 years. From a traditional IT products distributor, Ban Leong Technologies Limited has successfully transformed into a new generation technology-driven specialist distributor, according to their annual report. The transformation was spearheaded by Ban Leong's Managing Director since 1993, Ronald Tang, who is also Ban Leong's founder and current chairman. On the screen, we have Ban Leong's milestones since its inception in 1993. In 2003, the company expanded into Malaysia. A year after that, the company established Ban Leong Technologies Thailand Co. Limited. Then, in 2005, the company set up representative office in Vietnam and listed in SGX main board. After its expansion into Australia, the company sets up Ban Leong China Limited. Okay, so the company is growing so far. Okay, there are four sectors in the company's business. The first one is IT distribution, logistics, tech support, and product marketing. The company consists of 6 subsidiaries. They are Ban Leong Technologies Sendirian Berhad, Digital Hub Private Limited, Ban Leong Chin Inter Co. Limited, BLC China Limited, Ban Leong Technologies Australia Private Limited, and then AV Labs International Private Limited. Major shareholders as at 30 July 2020, Ban Leong's founder and current chairman Ronald Tang Wu Bun is the second largest individual shareholder of the company with 22.88% direct interest and 2.82% deemed interest from his spouse Teo Su Chik. Hope I pronounced the name correctly. The percentage of shareholding held in the hand of public was approximately 35% as of 30 July 2020, according to its annual report. And hence, the company has complied with Rule 723 of the SGX-ST listing manual. So, to see the company's profitability, here I plot earnings per share for the last 12 years since 2009. I also added the horizontal green dash line as a guide to zero level. Earnings below this line indicates that company is recording a loss for that particular year. In the 12 years review, Ban Leong's earnings are very It recorded two periods where it recorded 2 years earning decrease back to back. They are in 2011 and 2012, and then 2019 and 2020. As with the dips, there were also periods of high growth that was between 2016 to 2018. Yeah. Conservatively, I tend to look into the dips before being optimistic about the earnings spikes. So let's dig a little deeper of their decreased. Sieving through the annual reports, there are not much explicit points that can explain the dips. 2011 was the first year after Ban Leong returned to profit in 2010. This year, the company reported both decreasing revenue as well as rather increasing in expense. Southeast Asia market accounted for half of the decrease as the group was exporting less of the data storage products. Australia and New Zealand market accounted for the balance due to scaling down of the operations in New Zealand. 2012 financial statement noted 1.3 million goodwill impairment from their Australian operation, which doesn't look like a realized expense. The amount is about 1% of their revenue. 2015 dips, not yet. 2015 dip was reported mainly due to the increase in cost of product purchase. The increase was as a result of appreciating US dollar with respect to SGD. Okay, now we are talking about 2019, dip. The annual report didn't mention anything about that required attention. However, the financial statement did attribute the decrease in revenue, accessory, and storage products. One of the causes was reported that some of the accessories and storage products were discontinued. The company also mentioned increase in marketing activity to drive revenue. Despite that, I haven't heard the name of Ban Leong until I look at my husband's or daddy's Belluga portfolio. I may not the intended market for Ban Leong's product, perhaps. Yeah. In 2020, Ban Leong noted that the financial year started the heightened COVID-19 situation in Singapore. For the record, Ban Leong's financial year started in the 1st of April and ended in the 31st of March. As a result, the company had been facing a few challenges and also some benefits. One of those are the higher demand for equipment to enable work from home. Even that, profitability haven't been positively impacted in 2020 because the earnings were still in decrease in that year. It seems that the windfall of 2020 only realized in 2021 or this year, as the earnings for 2021 was almost doubled. Okay, so that was our first peek at the company's profitability. Next, we'll take a look at how much of those earnings were distributed to the shareholders and how sensible they were. To see the sensibility of dividend payout, here I plotted 3 layers of information. The first one is the dividend payout over the last 16 years, from 2005, which I plotted as red round markers, connected by a thick red line, as we can see on the screen. On each of the points, I have annotated with 2 numbers. The number above are the dividend payouts in Singapore dollars, and the ones below are the payout ratios to the respective years' earning per share. As a comparison to the earnings here, I plotted back the earnings per share as thinner line with the same color, red. At a glance, let's look at the screen, the graph. At a glance, I have some concerns about the dividend payment. From 2009 to 2016, the percentage of the dividend payouts vary. Though the nominals in SGD were pretty stable, around 1 to 2 cents. Okay, later, from 2017 onwards, the percentage of dividend payout or payout ratio fell below 60%, which was contributed by the increase in earnings, though the nominals in SGD were actually slightly increased. One thing that I can do to see the dividend sustainability is to make a circle back to the balance sheet and see if the company actually had sufficient cash to do this dividend payout ratio. Now let's look at the cash, the balance sheet. So today I have added the company's cash and the current liabilities. These light purple bars on the screen are the company's cash with the amount stated on the right hand axis. And the gray ones are the company's current liability. Current liability is my first choice for department that require cash. Current liability could cripple the company's operation as it needs to be settled in less than a year. What I want to see is that the cash reserve is higher than the current liabilities. That will be the ideal situation. Okay, now let's look at the graph, yeah? From the graph we have on the screen here, the picture doesn't look that pretty anymore. For as long as the data that we have since 2011, Ban Leong current liabilities is way higher than their cash reserves. The situation seems to get better this year. Perhaps it might be wise to cut down the payout ratio to reduce the debt burden and get to a better cash situation. Okay, now let's compare the dividend payout to their market valuation. In other words, their dividend yield. Okay, now this is what a dividend hunter might be waiting so far. Dividend yield history. Here I plotted the average dividend yield per year as the round markers. At each markers I place an error bar, which represent the range of yield over that year. The variation in a year is caused by the volatility level of the share price. The yield increase if the share price decrease and vice versa. We can see that the dividend yield is quite attractive. The lowest dividend yield was in 2009 and 2019, which were around 4%-ish. In Singapore context, 4%-ish is comparable to CPF ordinary account interest, which in my opinion is pretty good. It had even reached average of 15% before due to volatility of price. It had even reached around 30% in 2008. Currently, it hovers around 8%, which is pretty good. Considering the yield is significantly higher than the bank deposit, I guess they can save up a little bit more cash without hurting the share price, perhaps. Okay, now let's look at the market valuation. Yeah, I'm torn between the cash and liability situation and the dividend yield. Yeah, now I would like to see the market valuation and to know the reasonable price that I can put for this company if I decide to put some position. Okay. To see the sensibility of the price, as usual, the first I put the price, which represent market valuation of the company. It is also the easiest information that I can obtain. But price alone sometimes misleading for the value of the company and its prospect. So I'll include other fundamental indicators to help me to decide. The second layer of information is the 10 times earning multiply, which here I plotted as a dashed green line. 10 times earning multiply can be considered as the price where price to earning, that is the PE ratio, is 10. For me, I consider 10 times earning multiply has two purposes. The first one is it indicates the price where I expect, where I have higher chance to break even within 10 years. You could plot 5 times earning multiply if your investment horizon is 5 years, for example. Second, as a consequence for the first reason, I'll consider share price above 10 earning multiply to be expensive. The third layer of information is 15 times earning multiply. With same principle as 10 times earning multiply, price above this indicator will be deemed as expensive. Here I plotted the 15 times earning multiply as dashed yellow line, just like the traffic light. The fourth layer of information is the 20 times earning multiply. Here I plotted as dashed red line. I will consider the share price to be super expensive if it ever crossed this line. For non-growth company, I consider to cut down my position if this happened. Okay, so now let's see what's going on with Ban Leong share price. Okay, let's look at the screen. I can see that the market is valuating Ban Leong pretty conservatively. It has always been below 10 times earning multiply, except in 2012 to 2013 and then 2015 to 2016. So here I add the price annotation to see my reasonable price, yeah? Based on the current 10 times earning multiply, I will put a reasonable price at 60 cents. However, the earnings spike may be a COVID-19 windfall, which may just a one-time event. So I will opt out my conservative reasonable price at historical 20 times earning multiply, which is around 4 cents. No, sorry, I mean 10 times earning multiply, which is around 4 cents. Yeah. As of 5 November 2021, as we can see on the screen, when this video was prepared, Ban Leong stock price was in 37 cents, which is quite okay. Okay, so I'm considering to put a small position in this company, probably in near future before the price goes up again. I think I'm not that 100% confident of the company considering the current cash situation, but considering the dividend yield and payout ratio, I think probably okay to put small position and risk it for this company. Okay, so in conclusion, first, I can see that it's a potentially growing company. That's why I'm interested in risking it. Provided that it's a growing company, provided that it can leverage on the current sector growth. It has a high dividend yield, which I like, while currently having quite okay dividend payout ratio. I'm interested in putting a small position in the company in the near future. Though noting that I need to keep an eye on the cash and liabilities situation. Okay, that's all for today. Thanks for watching. Don't forget to leave comments, and if this video is useful for you, please consider to subscribe. It is free for you to do so, and it means a lot for a beginning YouTuber like me. Okay, thank you very much, and I'll see you again in my next video. Bye!